Most people look at oil and see only a commodity. They see a price on a screen, they see gasoline at the pump, they see headlines about war, OPEC, Iran, tankers, and politicians. But I do not look at oil that way. I look at oil as one of the main arteries of the world economy. It moves goods, it moves people, it powers logistics, it affects inflation, it affects central banks, it affects corporate margins, it affects consumer spending, it affects political stability, and when the flow of oil is interrupted, the consequences do not stay inside the energy market, they move through the whole system. That is why I am investing in oil right now. Not because oil is paying me to say that, not because I want to make a dramatic short-term bet, not because I think anyone should blindly copy a trade without understanding the risk. I am doing it because I believe the market is underestimating a real structural supply shock. And because oil may serve as a hedge against a broader stock market decline if the shock intensifies, that distinction matters. I am not looking at oil in isolation. I am looking at oil in relation to the rest of my portfolio. I want to stay long my core positions. I do not want to sell my gold, silver, metals, or SP 500 exposure just because the world looks dangerous. I believe in long-term investing, but I also know that a major oil shock can put pressure on the stock market. It can raise inflation expectations. It can hurt consumers. It can compress corporate margins. It can force central banks into harder decisions. It can scare investors. So if oil spikes and stocks fall, I would rather have something inside the portfolio that moves in the opposite direction or at least cushions the damage. That is the first principle. A hedge is not only something you buy to make money, it is something you buy so the rest of your system can survive a bad scenario. And right now, the bad scenario is not theoretical. The center of the problem is the Strait of Hormuz. The Strait of Hormuz is one of the most important oil routes on Earth. Normally, about 20% of global oil supply flows through it. That is not a small figure. It means 1 out of every 5 barrels in the world depends on that narrow route. Most people do not think about that because when systems work, we stop noticing them. The tanker moves, the refinery receives crude, the fuel arrives, the truck delivers goods, the consumer buys products, the economic machine keeps moving. But when one artery carries that much of the world's energy, a disruption in that artery can affect everything. The source describes normal traffic before the war as roughly 120 to 150 vessels passing through the strait each day. Now, that number has dropped to something like 0 to 10 per Dalton Y. Tankers are not passing normally, some are afraid of being attacked, some are worried about seizure. The US Navy is involved. Insurance companies may pull coverage or charge rates so high that shipping becomes uneconomic. Oil exports are being choked, and once exports are choked, the question becomes arithmetic. How much supply is disappearing? The source describes roughly 20 million barrels normally moving through the strait. Some oil is still getting out, some is rerouted through pipelines, some countries are still partially exporting, but the estimated disruption is about 12 million barrels per Dalton Y removed from supply. 12 million barrels. Per Dalton Y, that is the number. It represents about 12% of global supply and about 30% of exports in the source S framing. To put that into perspective, the 1973 oil crisis removed about 7% of supply. This shock is described as closer to 12%. That is why the situation is not normal. It is not just another geopolitical headline. It is one of the largest supply disruptions the oil market has had to absorb. That is the second principle. When a vital flow is disrupted, the size of the missing flow matters more than the headline itself. The market can ignore a headline. It cannot ignore missing barrels forever. Now, oil has already moved higher, prices have surged above $100 per barrel in the source S description. But the key point is that this price spike is not necessarily happening because the physical shortage is already fully visible at the consumer level. It is happening in anticipation of shortage. That is a very important distinction. Markets move before the shelves are empty. Oil traders do not wait until every refinery is screaming for supply. They price risk before the shortage becomes obvious. They see the flow disruption, they see inventories being drawn down, they see geopolitical escalation, they see insurance costs, they see ships not moving, they see pipelines unable to replace everything. They see the math, so the price rises first. Then, if the disruption continues long enough, the real shortage appears. This is why the situation can look confusing to ordinary observers. They see oil above $100 and say, if this is really so serious, why is oil not already at extreme record highs? That is the wrong question. The better question is, what is preventing the price from moving even higher right now? The answer is inventories. Inventories are the buffer. Inventories are the shock absorber. Inventories are the reason the market can temporarily withstand a flow disruption without immediately breaking. But buffers are not permanent. They get used. That is the third principle. Inventories can hide a shortage for a while, but they cannot erase a shortage if the disruption continues. At the start of the year, the source says global oil inventories were about 8.4 billion barrels. That number sounds enormous. It includes commercial storage, tank farms, refineries, terminals, floating storage sitting on tankers, strategic reserves, and government stockpiles. On paper, 8.4 billion barrels sounds like a wall of protection. But in oil markets, the headline inventory number is not the same as the amount that can be used quickly, economically, and in the right place. This is where many people make a mistake. They hear 8.4 billion barrels and assume the world has plenty of oil ready to solve the problem. But oil sitting in the wrong place does not solve a shortage somewhere else. Oil in strategic reserves is not part of normal daily supply. Oil that needs refining is not the same as usable fuel. Oil that cannot be moved quickly is not immediately available. Oil that is the wrong crude grade may not be suitable for a refinery that needs a different grade. Oil trapped behind the same shipping disruption is not useful to the market that needs it. The source cites estimates that perhaps only 800 million barrels may be realistically available under one view, while other estimates range to 2.5 billion or 2.8 billion barrels depending on the source and definition. Even if we take the larger numbers, the basic problem remains. If 12 million barrels per Dalton Y are removed from supply, then over 100 days that is 1.2 billion barrels. And the war has already been going on for a little more than 2 months in the source. Its timeline, the panic does not begin when the last barrel is gone. The panic begins when inventories fall to levels the market considers dangerous. Nobody knows exactly where that level is because markets are psychological as well as physical. But every day that the disruption continues, the system moves closer to that point. That is the fourth principle. The market does not wait for exhaustion. It panics when it believes the buffer is no longer credible. This is why the current price may not tell the whole story. If inventories are still absorbing the shock, the market can look strained but not broken. Prices rise, but not as much as they might if the buffer disappears. But once the buffer becomes visibly thin, the same market can reprice much more violently. Supply and demand are not philosophical ideas. They are forces if supply is reduced, and demand does not fall enough. Prices must rise high enough to force demand destruction. That is the key phrase. Demand destruction when supply disappears. The market needs some users to stop consuming, reduce consumption, delay consumption, or be priced out. The mechanism that forces that adjustment is price. If oil at $100 does not reduce enough demand, oil must go higher. If oil at $130 does not reduce enough demand, oil must go higher. If oil at $150 does not reduce enough demand, oil must go higher still. The source argues that $130 or $150 may not be enough if the war drags on and the Strait of Hormuz remains restricted. That is not a prediction made for entertainment. It is a supply and demand statement. That is the fifth principle. In a real supply shock, price must rise until enough demand disappears or enough supply returns. There is no emotional compromise with arithmetic. If the world needs more oil than it can physically access, the price becomes the rationing mechanism. This is why oil can be so dangerous for the broader economy. Oil is not a luxury item that people can easily stop using. It is embedded in transportation, agriculture, shipping, manufacturing, plastics, aviation, military logistics, and consumer life. Demand is not perfectly flexible in the short term. People still need to drive, goods still need to move, factories still need energy, airlines still need fuel, trucks still need diesel. If demand cannot fall quickly, price can rise sharply. That is what creates economic pressure. And that is why oil shocks can crash stock markets. When oil prices spike, costs rise across the system. Consumers have less disposable income, businesses face higher input costs, margins fall, inflation may rise, central banks may be less willing to cut rates, bond yields may respond, investor sentiment weakens, growth expectations fall, the shock spreads. It does not remain inside oil. That is the sixth principle. Oil is not just an energy price, it is an economic transmission mechanism. This is why I am not viewing oil merely as a trade. I am viewing it as a hedge. If oil rises because a supply shock worsens, the stock market may suffer. If my core portfolio falls 20, 25, or 30%, an oil position that gains in that environment can reduce the overall drawdown. It may also give me profits that can be redeployed into stocks at lower prices. That is the strategy. If oil spikes and stocks crash, the oil gains become buying power. If the war ends and oil falls, then the rest of the portfolio may continue doing well because the major risk has been removed. In the second scenario, I may lose on the oil hedge, but I benefit from the broader portfolio. That is what a hedge is supposed to do. The seventh principle, a hedge can lose money in the good scenario and still be rational because it protects the bad scenario. This is the part many people misunderstand. They judge a hedge as if it is a standalone investment. They ask whether it will make money. That question is incomplete. The better question is what the hedge does to the entire portfolio under stress. If the war ends tomorrow, oil may fall. That is a risk. But if the war ends, the stock market may breathe easier, inflation expectations may improve, and the rest of the portfolio may benefit. In that case, the hedge was not needed, but the system survived. If the war continues, oil may rise significantly and stocks may fall. In that case, the hedge may reduce damage and provide capital to buy the dip. That is the system-level view. Now let us talk about the price chart. The source describes WTI crude floating around the $60 range for much of the prior year, then moving sharply higher during the shock. The source also references the 2008 oil spike when crude reached about $147 per barrel without a comparable Hormuz supply disruption. That comparison matters because 2008 dollars are not the same as today. Dollars adjusted for inflation, $147 in 2008 would be far higher in today's dollars, easily above $200 in the source's framing. So when oil is around $105 and the market is experiencing the biggest disruption described in the source, the argument is that the price may not yet reflect the full stress. This does not mean oil must go to $200. It means there is historical context showing that much higher oil prices are possible if the market believes supply is truly constrained. That is the eighth principle. The current price is not automatically the ceiling just because it has already moved. A price can look high relative to last month and still be low relative to the severity of the shock. This is why chasing is dangerous, but ignoring the situation may also be dangerous. The source says the position was initiated after a pullback rather than chasing the first spike. That is important in a volatile market. Entry matters. If you buy emotionally after a vertical move, you may get punished by a pullback even if the larger thesis is right. Waiting for a pullback can reduce risk, though it cannot eliminate it. Oil is volatile. Geopolitical trades are volatile. A headline can move the price sharply in either direction. That is why position sizing matters. The ninth principle, the more volatile the hedge, the more disciplined the position size must be. If a hedge is too large, it stops being a hedge and becomes the portfolio. That is not what I want. I do not want oil to dominate the entire investment plan. I want it to serve a purpose, protect against an oil-driven shock that could damage stocks. The size should reflect that job. Too small and it does not matter. Too large and the hedge itself can create major damage if the situation escalates. This is why risk management must come before excitement. Now let us examine the key risk. De-escalation. If the war de-escalates, if the Strait of Hormuz reopens, if tankers resume normal passage, if insurance markets normalize, if supply returns, then oil can fall quickly. That is the biggest risk to the oil position. In that scenario, the supply shock premium comes out of the price. Traders who bought oil for disruption may sell. Prices can decline sharply. Oil equities or oil-related instruments can also fall depending on the vehicle used. This is why the trade is not risk free. There is no risk free hedge. Every hedge has cost. The 10th principle, every protection has a failure mode. Gold can fail if real rates rise. Bonds can fail if inflation rises. Cash can fail if inflation eats purchasing power. Oil can fail if the supply shock ends. That is why you must know what would make the hedge wrong. For oil, the thesis is wrong or less valuable if the strait reopens, if the war de-escalates, if inventories prove more available than expected, if demand falls faster than supply, if governments release enough reserves effectively, or if markets decide the disruption is temporary. Those are real risks. A serious investor must say them out loud. If you cannot explain how you lose money, you do not understand the investment. That is the 11th principle. The first step in taking risk is naming the risk. Now let us look at why reopening the strait is not simple in the source S reasoning. The United States is militarily stronger than Iran. That is not the issue. The issue is cost, terrain, escalation, and infrastructure vulnerability. The source compares it to a lion fighting a porcupine or honey badger. The stronger animal may win, but the fight can still be painful and costly. Forcing the strait open militarily may be possible, but at what cost? If Iran responds by damaging oil infrastructure in the Gulf, then reopening the waterway may not restore exports quickly because the producers may not have functioning infrastructure to export through it. Pipelines, terminals, loading facilities, refineries, storage, and shipping routes are not abstract, they are physical assets. Physical assets can be damaged. Damaged infrastructure takes time to repair. That is why the situation is not clean. It is not simply use force and the oil flows. Again, geopolitical systems are nonlinear. One action creates responses. Responses create new constraints. That is the 12th principle. Military superiority does not automatically equal economic restoration. Oil markets care about barrels flowing, not only about who is stronger. If a conflict expands and infrastructure is hit, the supply problem can worsen even if the military balance looks obvious. This is why the market may still be underestimating the problem. Investors often assume that powerful countries can reopen critical routes quickly. Sometimes they can. Sometimes the physical and political consequences make the solution messy. The market may price the first part of the story but not the second-order effects. That is where opportunity and risk both live. Now, let us discuss insurance. Shipping insurance is one of the invisible mechanisms that can stop supply. A tanker does not need to be sunk for shipping to halt. If insurers refuse coverage or if premiums become too high, the route can become economically infeasible. Owners may not risk vessels. Lenders may not accept the exposure. Charterers may not take the risk. Crews may not sail. This is how fear becomes supply reduction. No barrel needs to vanish underground. It simply fails to move. That is the 13th principle in global trade. Risk pricing can become a physical constraint. If the insurance market says the route is too dangerous, supply behaves as if the route is blocked, even before every ship is attacked. This is why vessel count matters. Going from over 100 vessels per Dalton Y to almost none is not a small signal. It shows that the System S participants are changing behavior. Tanker owners, insurers, governments, militaries, buyers, and sellers are all responding to risk. Markets should pay attention to behavior more than official statements. The strait may not be declared closed in the simplest sense, but if ships are not moving, the flow is disrupted. The 14th principle in markets, actual flow matters more than formal labels. A route can be technically open and functionally impaired. That is what matters to oil supply. Now, let us return to inventories because they are central. Inventories can delay the crisis, but they also create complacency. As long as products are available and prices are not exploding beyond control, people assume the system is fine. But the inventory buffer is being drawn down every day. If 12 million barrels per Dalton Y are missing, even large inventories shrink quickly, and not all inventories are equal. Strategic reserves are political assets. Governments may not release all of them because they need emergency protection. Commercial inventories are tied to logistics and contracts. Floating storage may be in the wrong location. Crude may need refining. Refineries may need specific grades. Release capacity may be limited by ports, pipelines, vessels, trucks, and processing capacity. This is not a simple warehouse problem. It is a logistics system. The 15th principle in energy. Availability is not only about quantity, it is about location, grade, transport, timing, and political willingness. This is why a large global number can mislead people. The world may technically have billions of barrels in inventory, but the market may only be able to draw a much smaller amount quickly and usefully. And once that realistic drawdown capacity becomes stressed, prices can move sharply. This is why I am watching the pace of inventory drawdown, not only the headline price. The price is the market's current opinion. Inventories are the system's physical buffer. If the physical buffer keeps shrinking, the opinion can change quickly. Now, let us examine the demand destruction level. The source argues that $130 or $150 may not be enough. Why might that be true? Because short-term oil demand can be sticky. People do not instantly stop driving. Airlines do not instantly stop flying. Supply chains do not instantly reorganize. Factories do not instantly redesign energy use. Governments may subsidize fuel. Businesses may absorb costs temporarily. Consumers may reduce other spending before reducing fuel. So the price required to destroy enough demand may be much higher than people expect. That is the danger. If the market assumes $105 is already high enough, but actual demand remains too strong relative to disrupted supply, prices may need to climb further. The 16th principle. When demand is inelastic, the price adjustment must be larger. This is why energy shocks can be violent. A small shortage in a necessary commodity can create a large price move. And a large shortage can create a very large price move. This does not mean the highest forecast must happen. It means the risk distribution is asymmetric. If the strait reopens, oil can fall. If the strait stays restricted and inventories shrink, oil can move much higher. The range of outcomes is wide. That is why position sizing and exit planning matter. Now, let us talk about the relationship between oil and stocks. Oil shocks can hurt equities in several ways. First, higher energy prices reduce consumer spending power. If households spend more on gasoline, heating, transportation, and goods affected by fuel costs, they have less to spend elsewhere. Second, higher oil prices increase business costs. Transportation, manufacturing, airlines, chemicals, logistics, and many other industries feel pressure. Third, higher oil can feed inflation data that can make central banks more cautious. If inflation expectations rise, interest rates may stay higher for longer, pressuring valuations. Fourth, geopolitical shocks reduce risk appetite. Investors may sell equities and buy safer or commodity-linked assets. Fifth, corporate earnings expectations may fall if costs rise and demand slows. This is how an oil shock becomes a stock market shock. That is the 17th principle. Oil can crash stocks not because oil is part of every index, but because oil affects the economic conditions every index depends on. This is why I do not want to sell the SP 500 preemptively. Selling long-term positions can create tax costs, timing risk, and the possibility of missing gains if the crisis resolves. Instead, a hedge can allow me to stay invested while reducing the damage if the risk materializes. That is the portfolio logic. Stay long the core. Add a hedge against the specific shock. Use hedge profits to buy the dip if the shock creates a sell-off. This is not a guarantee. It is a risk management design. The 18th principle, a good hedge can help you avoid selling long-term assets for short-term fear. That is one of its highest values. If you can remain invested through a crisis because the hedge reduces panic, the hedge may be valuable even if the profit is not perfect. Now let us address the emotional temptation. When oil rises quickly, people want to chase. They see the chart and feel they are missing out. That is dangerous. The correct reason to buy oil is not that it has gone up. The correct reason is that the supply-demand imbalance may not yet be fully reflected, and the position serves a defined role in the portfolio if the price has already moved too far relative to risk. The trade may be unattractive. If the position size is too large, the trade may be dangerous. If there is no exit plan, the trade may become emotional. If de-escalation occurs, the price can reverse fast. This is why no one should blindly buy oil because someone says they are buying oil. That is the 19th principle, a trade without a thesis, position size. An exit condition is not a strategy, it is imitation. Imitation is dangerous because the person copying usually does not know the risk that the original investor is willing to take. They do not know the entry price. They do not know the position size. They do not know the stop or exit condition. They do not know the portfolio context. They only see the headline. Do not invest that way. Now let us talk about how to think about oil exposure. There are different ways to express an oil view. One could use oil futures, oil ETFs, energy equities, energy sector ETFs options, or companies tied to exploration, production pipelines, or services. Each behaves differently. Futures have role dynamics and expiration issues. Oil ETFs can have tracking costs. Energy companies depend on balance sheets, costs, management, and equity. Market sentiment options can expire worthless. Leveraged products can decay and behave dangerously. The instrument matters. Buying oil exposure is not the same as buying oil in a barrel and storing it. That is the 20th principle. The thesis may be oil, but the risk is in the instrument you choose. A person can be right about oil prices and still lose money if the instrument is poorly chosen, badly timed, over-leveraged, or misunderstood. This is why investors must understand what they own. Now, let us return to the source. Central point. This environment is not normal. A normal oil market has fluctuations. Demand rises and falls. OPEC adjusts. Inventories move. Prices respond. But a critical route carrying roughly 1/5 of global oil flow becoming severely disrupted is not normal. Vessel traffic collapsing is not normal. 12 million barrels per Dalton Y removed from supply is not normal. Inventories being drawn rapidly is not normal. War risk and insurance withdrawal are not normal. So the investor must ask, if this is not normal, is the market pricing it as not normal? The source's answer is no. Oil has risen, but not enough relative to the potential shortage. That is the opportunity, the 21st principle. A market can react to a crisis and still underprice the full consequences of that crisis. This happens because markets process information unevenly. Some participants focus on current price, some focus on inventories, some expect quick political resolutions, some are constrained by mandates, some cannot own commodities, some underestimate logistics, some assume government intervention will solve the issue. This creates disagreement. Disagreement creates volatility. Volatility creates risk and opportunity. Now let us think in scenarios. Scenario 1, the war de-escalates and Hormuz flows normalize. Oil falls. The oil hedge loses money, but stocks may rally, inflation fears ease, and the core portfolio may benefit. Scenario 2, the war drags on, but inventories remain sufficient longer than expected. Oil stays elevated but does not explode. The hedge may produce modest gains or volatility. Stocks may remain under pressure but not collapse. Scenario 3, the war drags on, inventories fall to concerning levels, and demand destruction requires much higher prices. Oil rises sharply, stocks may sell off. The hedge becomes valuable. Scenario 4, military action forces the strait open but damages Gulf infrastructure or escalates the conflict. Oil may spike even if the route is technically reopened because export capacity is impaired. Scenario 5, global recession reduces demand enough to offset supply disruption. Oil may not rise as much, or it may fall despite the supply problem if demand collapses. These scenarios show why the trade is not simple. There is no single guaranteed path. That is the 22nd principle. Investing under geopolitical risk requires scenario thinking, not single outcome certainty. This is how I would think about the position. Not oil must go up. Rather, if the high-impact scenarios occur, oil may protect the portfolio. That is the role. Now let us talk about portfolio drawdown. If the stock market falls 25 or 30% because of an oil shock, many investors will feel enormous pressure to sell. If the oil hedge offsets part of that, maybe the portfolio falls only 5 or 10%. That difference is not just mathematical, it is psychological. A smaller drawdown is easier to hold. If you can hold, you can recover. If you panic sell, you may destroy the plan. That is the 23rd principle. The best hedge may be the one that helps you avoid your worst emotional mistake. This matters because investing is not only about maximizing return, it is about staying solvent and rational through bad environments. A hedge can reduce fear, and reduced fear can protect long-term behavior. Now suppose oil gains because the shock worsens. What should be done with the profit? The source plan is to use oil gains to buy the stock market dip if oil spikes and stocks crash. That makes sense as a system. The hedge pays when the core assets are under pressure. Then the hedge profit is redeployed into the core assets at cheaper prices. This is a disciplined way to turn crisis into opportunity. The 24th principle. A hedge should have a destination for its profits. If you do not know what you will do if the hedge works, you may waste the benefit. The plan should be defined before the crisis. If oil spikes, how much do you trim? At what point do you use gains to buy stocks? How do you avoid holding the hedge too long after the risk has peaked? These are important questions. A hedge can become a new risk if you fall in love with it after it works. That is the 25th principle. A hedge that works must still be managed. The purpose is not to marry the hedge, the purpose is to protect and then reallocate. Now, let us talk about what could make oil fall even without peace. Demand destruction itself can eventually cap prices. If oil rises high enough, consumers reduce usage, businesses slow activity, governments release reserves, economies weaken, and demand falls. That can bring prices down. In a severe recession, oil can fall despite supply stress. This is another risk. An oil position can benefit from supply shock, but if the supply shock triggers a major recession and demand collapses fast enough, the price can reverse. This is why the position cannot be treated as risk. Free, the 26th principle. The same force that makes oil rise can eventually create the conditions that make oil fall. High prices solve high prices by destroying demand or inducing supply responses. That timing is hard to predict. Now let us think about government responses. Governments can release strategic reserves, they can pressure producers, they can coordinate diplomacy, they can subsidize fuel, they can adjust regulations, they can use military assets, they can ask allies to help, but none of these tools is infinite. Strategic reserves cannot be fully emptied without creating future vulnerability. Other producers may not have enough spare capacity, diplomacy may fail, military action may escalate. Subsidies may worsen fiscal pressure. This is why government response can help but may not fully solve the shortage. The 27th principle. Policy can delay market pressure, but it cannot repeal physical supply constraints. If barrels are not moving, somebody must consume less, use inventories, find alternative supply, or pay more. That is the arithmetic. Now let us discuss why the broader market may be slow to react. Investors can become numb to geopolitical headlines. They hear about conflicts, disruptions, sanctions, and threats so often that they assume each event will fade. Sometimes that assumption is correct. Many crises do de-escalate. Many scary headlines do not become structural shocks. But occasionally, a headline reflects a real flow disruption. That is when complacency is dangerous. The 28th principle. The market can become desensitized to headlines and miss the difference between noise and flow. A threat is not the same as a missing barrel. A speech is not the same as a tanker not moving. A headline is not the same as inventories drawing down. The serious investor watches the physical system. Now let us return to the strait itself. Hormuz is geographically narrow and strategically vital. When such a choke point is disrupted, alternatives matter. Can oil be rerouted? Some can. Can pipelines bypass the strait? Some can. Can other producers increase output? Some can. Within limits. But if the route normally handles 20 million barrels and 12 million are disrupted, the alternatives are not enough in the source S framing. This is why choke points matter. They concentrate risk. A diversified supply network can absorb localized problems. A choke point creates systemic exposure. The 29th principle. A choke point turns a regional conflict into a global economic problem. That is exactly why Hormuz matters more than many other regional disruptions. The world has built an energy system where a large share of oil relies on one narrow passage. When that passage is compromised, the risk is not local, it becomes global. Now, let us think about how this connects to inflation. Oil feeds into transportation and production. Higher oil prices can raise gasoline, diesel, jet fuel, shipping, food distribution, manufacturing, and chemical input costs. This can reaccelerate inflation at a time when markets may be hoping for lower rates or policy relief. If inflation rises because of oil, central banks face a difficult problem. The shock can slow growth and raise prices at the same time. That is stagflationary pressure. Central banks cannot create oil with interest rate policy. Cutting rates may support growth but risk inflation. Raising or keeping rates high may fight inflation but hurt the economy. That is the 30th principle. Energy shocks create policy dilemmas because they can raise inflation while weakening growth. This is why oil shocks can be especially dangerous for stocks. They attack earnings and valuations from multiple directions. Now let us examine the psychology of the investor. If someone owns only stocks and oil spikes, they may feel trapped. If stocks fall, they may sell. If they sell, they lock in losses. If they had a hedge, they may be calmer. If oil gained, they have cash to buy stocks lower. This is why the hedge is less about predicting every tick in oil and more about preserving decision-making quality. The 31st principle. Risk management is partly about protecting your future judgment. Bad environments make people make bad decisions. A hedge can help reduce the emotional pressure enough to keep the long-term plan intact. Now, let us talk about why this is not a recommendation for everyone. Some investors should not trade oil. They may not understand the instruments, they may overconcentrate, they may chase after the move, they may panic if it falls, they may lack a broader portfolio context, they may use leverage, they may confuse a hedge with a lottery ticket for them. Oil exposure could cause more harm than good. The correct lesson is not blindly buy oil. The correct lesson is understand why oil risk matters and decide whether your portfolio needs a hedge. That is the 32nd principle. A hedge must match the investor's knowledge, portfolio, and temperament. If you cannot size it, monitor it, and exit it rationally, do not take it. There are other ways to reduce risk: cash, bonds, gold, diversification, lower equity exposure, or simply holding through volatility. Oil is one possible hedge for a specific kind of shock. It is not the only tool. Now let us think about position timing. The source says the position was started after a pullback. This matters because even strong theses can be painful if entered emotionally. In commodities, price spikes can reverse sharply. A pullback can offer better risk reward, though it can also continue falling. There is no perfect entry, but chasing vertical moves increases risk. The 33rd principle in a volatile hedge: patience with entry can be as important as conviction in the thesis. Do not confuse urgency with discipline. A real supply shock may persist, but price will still fluctuate. Oil can rise 5% one day and fall 5% the next. This is normal in stressed markets. If you cannot handle that volatility, the position may be too large or inappropriate. Now, let us talk about exit. When do you sell the hedge? There are several possible exit signals. The strait reopens and traffic normalizes. Insurance markets stabilize, inventory drawdown slow. Oil reaches a level where demand destruction is clearly occurring. The stock market falls and hedge gains are needed to buy core assets. The geopolitical risk de-escalates. The position becomes too large relative to the portfolio. The thesis is invalidated without exit rules. A hedge can become a speculation. The 34th principle. A hedge should have conditions for both success and failure. If it works, what do you do? If it fails, what do you do? If the thesis changes, what do you do? This should be defined before emotions rise. Now let us consider the claim that this is the largest oil supply shock in history. That is a very strong claim from the source. Based on the estimated percentage of global supply disrupted, whether one labels it the largest or not, the key point in the rewrite is the scale. If 12% of global supply is disrupted, it is enormous compared with many historical oil shocks. The label matters less than the magnitude. The 35th principle: do not argue only about labels, measure the flow. If the missing flow is large enough to overwhelm buffers, the market must adjust. Now, let us think about what happens if oil goes much higher. At first, energy companies and oil-linked assets may benefit. Then inflation pressure rises, consumers weaken. Businesses face margin stress, the stock market may decline. Eventually demand destruction appears. Economic activity slows. Oil demand may weaken. The trade can become crowded. Governments intervene. This is a dynamic system. The 36th principle. The first order effect of higher oil may help oil assets. The second order effect can damage the economy. The third order effect can reduce oil demand. That is why timing and risk management matter. A hedge is not a permanent love story, it is a tool for a regime. When the regime changes, the tool may need to change. Now, let us talk about why gold, silver, metals, and SP 500 positions were not sold in the source S logic. Because long-term investing requires not abandoning core assets every time a crisis appears. Selling the whole portfolio because of one risk can create a different risk, the risk of missing recovery, paying taxes, or re-entering badly. A hedge is a more targeted response. If the risk is oil shock, an oil hedge is more specific than selling everything. This is the 37th principle. Targeted risks often deserve targeted hedges rather than complete portfolio abandonment. If you sell everything, you may protect against one scenario but expose yourself to another. If peace comes quickly, the market may rally, and you may be underinvested. A hedge lets you remain invested while addressing the specific shock. That is why portfolio construction matters. Now let us think about the broader lesson for investors. You cannot control war. You cannot control tanker traffic. You cannot control Iran. You cannot control the US Navy. You cannot control insurance companies. You cannot control global inventories. You cannot control oil prices, but you can control whether you understand the causal chain. Choke point disrupted. Tankers stop moving, supply removed, inventories drawn down, buffer erodes, prices rise to force demand destruction, high oil pressures, inflation and stocks. Oil hedge offsets some portfolio damage. Profits can be redeployed into a market decline. That is the chain, the 38th principle. When you understand the chain, you know where the risk enters your portfolio. Most investors react to price. Better investors understand cause and effect. Now, let us talk about avoiding hype. The source says there is no hype, just facts and logic in a rewritten Dalio voice. I would say it this way: do not buy the drama. Study the mechanism. If the mechanism is real, act rationally. If the mechanism changes, update the plan. That is the approach. Emotion may be loud, but it is not useful unless it points to something measurable. Vessel traffic is measurable. Supply disruption is measurable. Inventory drawdown is measurable. Price movement is measurable. Demand destruction is observable. Those are the things to watch. The 39th principle: separate the story from the mechanism. Stories move attention, mechanisms move markets. Now, let us discuss what most people miss. They think oil at $100 means the move already happened. But if the shortage has not yet become fully physical, the price may only reflect anticipation. If inventories are still cushioning the shock, the market may not yet have priced the moment when the cushion is gone. This is why the direction of inventories matters more than the current price alone. If inventories stabilize, the risk may fall. If inventories keep drawing quickly, the risk rises. If inventory levels reach concerning thresholds, the market can panic before the tanks are empty. The 40th principle: markets reprice when the buffer loses credibility, not when the buffer reaches zero. This is true in many systems. Banks fail before every dollar is gone. Currencies break before reserves are exactly zero. Commodity markets panic before storage is empty. Confidence in the buffer matters. Now, let us consider the possibility that analysts disagree on drawable inventories. Some estimate 800 million barrels. Others estimate 2.5 or 2.8 billion. That range is wide. The uncertainty itself is important. If the true accessible inventory is closer to the low estimate, the system is more fragile. If closer to the high estimate, the system has more time. But even the high estimates must be considered relative to the size of the daily disruption. At 12 million barrels per Dalton Y, time moves quickly. The 41st principle in a supply shock. Uncertainty about the buffer increases volatility. Nobody knows the exact panic point. That is what makes the market dangerous. Now, let us think about a normal investor asking, is it too late? That depends on the thesis, the current price, the instrument, the position size, and the risk tolerance. If the thesis is that oil could move much higher if the disruption continues and inventories weaken, then a price around 105 may not be the top. But if de-escalation happens, it may be too late immediately. This is why too late cannot be answered by price alone. It is answered by expected value across scenarios. The 42nd principle, an entry is attractive only if the upside scenario, downside scenario, and probability-weighted outcome justify the risk. If you cannot frame it that way, you are probably chasing. Now let us discuss how to avoid overconfidence. The source gives a clear opinion that oil can go above 150 if the war drags on. That may happen, it may not. Strong conviction can be useful, but overconfidence can be dangerous. The world can change. Suddenly, diplomatic breakthroughs happen. Government intervention happens. Demand can weaken, markets can front run and reverse. So hold conviction with humility. That is the 43rd principle, strong thesis, flexible mind. The thesis tells you why you entered. The evidence tells you whether you should stay. If the evidence changes, change. Now let us think about how this translates into a Ray Dalio-style risk framework. I would ask, what is the thing that can hurt me? An oil-driven market crash. What is the cause? A severe disruption in a critical oil choke point. What are the indicators? Vessel traffic, supply loss, inventory drawdown, price behavior, insurance conditions, war escalation, government action. What is the hedge? Oil exposure sized appropriately. What is the cost? Loss if de-escalation occurs. Volatility, instrument risk, opportunity cost. What is the payoff? Offset portfolio losses and create capital to buy depressed assets. What invalidates the thesis? Flows normalize, inventories stabilize, price fails to respond, despite continued disruption, demand collapses, or geopolitical resolution occurs. What is the exit when the hedge has done its job, when the thesis changes, or when risk-reward worsens? That is the system. The 44th principle. A hedge is a decision tree, not a feeling. Now let us discuss why this matters for people who do not buy oil, even if you do not take the trade. You should understand the risk. If oil spikes, your portfolio may be affected, your cost of living may be affected, your business may be affected, your travel costs may be affected, your inflation expectations may be affected, your central bank outlook may be affected. Oil is one of those variables that touches everything, so ignoring it because you do not trade commodities is a mistake. The 45th principle, you do not need to own oil for oil to own part of your economic life. Energy is embedded in the system, investors must watch it. Now let us talk about the difference between realized and unrealized loss. The source says he does not want to see the portfolio destroyed by 20% or more, even if the losses are unrealized. Some investors say unrealized losses do not matter because you have not sold. That is partly true, but not psychologically complete. Unrealized losses can still affect behavior. They can cause panic, they can force selling if liquidity is needed, they can damage confidence, they can reduce flexibility. So managing drawdown matters even if you are a long-term investor. The 46th principle. Unrealized losses are not final, but they can still create real behavioral risk. A hedge can reduce that behavioral risk. Now, let us think about the phrase, buy the dip. Many people say they will buy the dip, few actually do it. Why? Because when the dip arrives, the news looks terrible. If oil has spiked and stocks have crashed, the world will not feel safe. The emotional environment will discourage buying. That is why hedge profits can be powerful. They create both money and confidence. If your oil position is up while stocks are down, you can sell some oil and buy stocks. That action feels easier because you are using gains from the crisis to buy assets hurt by the crisis. The 47th principle, the best dip buying capital is capital created by the thing that caused the dip. That is a sophisticated idea. It turns the shock into funding for long-term assets. But again, it requires discipline. Now, let us think about what if the hedge does not work perfectly. Oil may rise and stocks may not fall. Oil may fall and stocks may also fall due to another reason. Oil may be volatile and the instrument may underperform spot crude. The hedge may only partially offset losses. That is normal. No hedge is perfect. A hedge reduces a specific risk. It does not eliminate all risk. The 48th principle, a hedge is not a guarantee. It is a probability tool. If you want guarantees, markets will disappoint you. If you want better risk balance, hedges can help. Now, let us bring the whole argument back to the present situation described in the source. A critical oil route is severely disrupted. Vessel traffic has nearly stopped. A large portion of global oil supply is missing. Some oil still moves, but not enough to replace the missing flow. Inventories are the current buffer. Only part of inventory is realistically available. That buffer is being drawn down rapidly. Prices have risen above $100 but may not yet reflect true shortage conditions. If the war continues, prices may need to rise much higher to force demand destruction. Higher oil can damage stocks. An oil position can hedge that stock market risk. The biggest risk is de-escalation and supply reopening. This is the entire structure. The 49th principle, if you can summarize the thesis clearly, you can manage it more rationally. If you cannot, you are likely trading noise. Now, let us discuss what I would not do. I would not sell all my long-term investments out of fear. I would not buy oil with reckless leverage. I would not put my whole portfolio into one commodity. I would not chase every intraday move. I would not ignore the possibility of de-escalation. I would not assume inventories are useless. I would not assume governments are powerless. I would not assume the market must immediately agree with me. I would not confuse a hedge with certainty. That is the 50th principle. Good risk management includes knowing what not to do. The goal is not excitement. The goal is protection plus opportunity. Now let us talk about the moral and human side. If the war ends, that is the better outcome. People live, supply normalizes, inflation pressure eases, the stock market may perform better. The world becomes less dangerous. I would rather lose money on a hedge and have the war end than make money because a crisis worsens. That is important. Investing in a hedge does not mean hoping for disaster. It means preparing for disaster. The 51st principle, preparation is not the same as desire. A person buys insurance without wanting a fire. A person buys an oil hedge without wanting war. That is how rational planning works. Now, let us think about this from the standpoint of systems. The world economy is an interdependent machine. Oil routes, shipping insurance, naval power, strategic reserves, refineries, consumer demand, central banks, equity valuations, and investor psychology are all connected. A shock in one part can propagate into many others. This is why simple narratives fail. The Strait of Hormuz is not only a waterway, it is a node in a global system. A disruption there can affect barrels, prices, inflation, stocks, interest rates, and households. The 50-second principle in a connected system. The second and third consequences often matter more than the first headline. The first headline is shipping disruption. The second consequence is lost supply. The third consequence is inventory drawdown. The fourth consequence is price spike. The fifth consequence is demand destruction. The sixth consequence is stock market pressure. The seventh consequence is a buying opportunity for those who prepared. That is the chain. Now let us consider how to monitor the thesis going forward. Watch tanker traffic through the strait. Watch insurance rates and coverage availability. Watch government statements. But do not rely only on them. Watch actual oil exports. Watch global inventory data. Watch WTI and Brent price behavior. Watch refinery margins and physical market signals. Watch whether strategic reserves are being released. Watch whether the stock market reacts to oil price moves. Watch signs of demand destruction. Watch de-escalation signals. These indicators will tell you whether the thesis is strengthening or weakening. The 53rd principle. A thesis must be monitored through the variables that drive it. Do not monitor only price. Price is important, but price is also the market's interpretation. The physical variables tell you whether the underlying stress is worsening. Now, let us talk about humility again. The market can stay irrational longer than a person expects. Oil can underreact for a while, then overreact later. It can spike suddenly and fall suddenly. A thesis can be right but early. A thesis can be right but expressed through the wrong instrument. A thesis can be right but too large for the portfolio, so the investor must stay humble. The 54th principle. Being right about the direction is not enough. You must survive the path. This is true in oil, stocks, bonds, gold, and every market path matters. Volatility matters, sizing matters, liquidity matters. Now, let us bring this toward a conclusion. I am investing in oil because the source describes a structural oil supply shock tied to the Strait of Hormuz. The flow disruption is large, inventories are buffering the shock, but that buffer is being depleted. If the war continues and the strait remains restricted, prices may need to rise much higher to force demand destruction. If oil spikes, stocks may fall. Therefore, oil can serve as a hedge against a potential stock market crash. That is the logic. It is not risk. The biggest risk is that the conflict escalates and supply reopens. The second risk is that demand weakens enough to offset supply disruption. The third risk is that the instrument chosen behaves differently from spot oil. The fourth risk is position sizing. The fifth risk is falling in love with the hedge after it works. These risks are real. But the risk of doing nothing is also real if the portfolio is exposed to an oil-driven market decline. The 55th principle, risk management, is not about eliminating risk. It is about choosing which risks you want to carry and which risks you want to offset. That is the entire point. Now let me end with the most important idea. Oil is not just a trade right now. It is a signal. It is a signal that the world's energy system is under stress. It is a signal that inventories are more important than headline numbers suggest. It is a signal that geopolitical choke points can still move the global economy. It is a signal that stock portfolios can be vulnerable to shocks outside the stock market. It is a signal that investors need systems, not opinions. If the Strait of Hormuz reopens and the crisis fades, the hedge may lose money, but the broader portfolio may benefit. If the strait remains restricted and inventories keep falling, oil may move much higher, and the hedge may protect the portfolio. Those are the scenarios. I do not know exactly which one will happen. No one does. But I do know that a portfolio should be built to survive more than one future. That is the final principle. Do not predict one future and bet your life on it. Prepare for several futures and size your risks so you can stay in the game. That is why I am investing in oil. Not because I want war. Not because I want stocks to crash. Not because I want to abandon long-term investing. I am investing in oil because the current supply shock may be underpriced, because the inventory buffer may be eroding, because oil can rise enough to hurt the broader market, and because a hedge can give me the ability to hold my core assets and buy more if fear creates an opportunity. That is the system, and in markets, especially during geopolitical shocks, the investor with a system usually has a better chance than the investor with only an opinion.